tax-efficient investments. Maya Fisher-French making sense of it all for us from our Cape Town studio this morning. Maya, a very good morning to you. Educate me. What is it that we're talking about? How do I avoid paying tax on my investments, if possible?
Well, I must tell you, it was quite interesting. I got a reader wrote to me recently, and he said to me, I don't know why, but I'm suddenly paying tax on my investments at the bank. So, you know, you had a fixed deposit and suddenly you had this tax bill. And I think a lot of people don't realize that we actually pay investment taxes. You know, we all focus on that when we're spending money, but we don't realize that even when we save money, we're paying tax. You never stop paying tax. And what he didn't understand or realize was that you start to pay tax on your interest when you start to earn more than 23,800 Rand a year in interest. So obviously he had accumulated the money, he'd been putting the money away, and he'd been doing quite a good job of it, but he got up to a point which maybe, depending on his interest rate, was about 450,000 Rand, and suddenly he started to pay tax. So I think it's a very important thing to realize is that if you're putting your money in the bank and you put in too much money in the bank, well, I won't say it's always good to have savings, but if you reach a point where you're starting to earn more than 23,800 Rand in interest, you're going to start having to pay tax in your tax return. Somebody who's 65 years old or older will only pay tax once they reach about 34,500 Rand in interest. They get a little bit of a breather there. But that's not the only place that you're paying investment tax. And in fact, you're probably already paying tax that you don't realize in the form of dividend tax. So that's when you go and you put your money into unit trusts or an exchange traded fund or anything that invests in shares in the Johannesburg Stock Exchange, because those companies pay you a dividend usually twice a year, and there's a 20% tax on that dividend. Except in this case, you don't pay the tax. The company that you invested in, say for example you've got shares in Pick n Pay or Woolworths or MTN, those companies pay that tax before paying out the dividends. So you're already paying investment tax if you're invested in unit trusts or exchange traded funds or other of those sorts of assets. And then finally we've got capital gains tax. And again, I find sometimes people think about capital gains tax when it comes to their houses or to property. There's always articles about how to calculate capital gains tax on property. But actually, capital gains tax applies to any investment that has a capital growth element. So that could even include a gold coin, for example, or again, going back to those unit trusts or share portfolio, anything that actually grows in capital, you will be paying capital gains tax. So whether you've got your money in the bank, whether you're investing in shares, whether you're holding gold coins, you're going to be paying tax at some point.
So it doesn't sound like you can win much on any platform, Maya. But and I suppose many out there are sitting at home wondering, well, what's the point then? I should just spend my money or keep it under the mattress like in the old days? Or can you be wise about where you're investing this money so that you can cushion this blow a little bit?
Look, let's be honest, if you have enough capital that you've got a tax problem, that's a good thing, okay? So don't think that paying tax is a bad thing. Be proud of the fact that you've actually accumulated enough wealth where tax is becoming a problem. So I wouldn't advise that as to go and spend your money instead. But yes, why not be tax efficient? I mean, why pay more tax than you need to? So the starting point is a tax-free savings account. And, you know, you can invest up to 33,000 Rand a year into a tax-free savings account, and you pay none of those, no tax on interest, on dividends or on capital gains. Unfortunately for this particular reader who wrote in, that wouldn't really assist him immediately because, you know, he had a capital amount of about 450,000 Rand. So you can't just transfer all of that immediately into a tax-free savings account because you've got this annual cap. So, but certainly if you're accumulating wealth and you're starting to save and invest, you definitely want to at least start in something like that, because why pay the tax if you don't need to? The next one that people may very well know about are retirement funds. That includes retirement annuities, your company pension or provident fund. Those do not pay any investment tax. The growth within there is able to grow without being taxed. And of course you get the added benefit of not paying tax on your, you're able to deduct it off your income as well. So that's like a real tax boost. And the third one that people may hear about, financial advisors may talk to them about, are endowment funds. But endowment funds actually are taxable. It's just the way they get taxed that's different. So in an endowment policy, you would buy a policy with an insurance company, and that insurer actually pays the tax at the company tax rate of 28%. So if your tax rate's higher than that, you could benefit from being an endowment policy, but you are actually still paying tax. So I think the bottom line is you really need to just try and use those mechanisms that you can. Make sure at least your starting of your investments is in a tax-free savings account. Make sure you're using the retirement benefits, and then also look at ways just to diversify across various asset classes. So if you try and keep if you're putting money in a bank, try and keep it below that threshold, and spread it. There's dividend, although there's dividend tax, it's not as it's only on the dividend, it's not on the capital. So also watch the capital gains tax. So I think it is about just having a spread of portfolio and looking for tax efficient ways to invest.
Okay, thanks very much for that, Maya Fisher French. How taxes impact your investment, it's not necessarily a bad thing, she said.